Please stay tuned for important disclosure information at the conclusion of this episode.
This is Destination Retirement with Robert Kuhn from Kuhn Capital Partners. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Robert provides his clients and prospects the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful strategies to put you on the path to achieving your retirement goals. And now here is Destination Retirement with Robert Kuhn.
To make sure that we are incorporating strategies that can do well when the markets lose money. Yes, you can make positive returns. You can receive positive returns if you have the right strategy in place when the markets are down. That is the job of the advisor. That's something we're going to start to talk an awful lot about, especially going into the summer, especially with what's going on in the market, valuations, interest rates. It is just a very broken industry. For those of you that have listened to my radio show for any length of time, you understand that that is how we feel. And our job is to make sure that we are adding strategies that when the markets are down, that you can still make money. So with that being said, if you have any questions when it comes to investing, please give Paige a call. She will set up a call for us to have an initial conversation, see what we can do to help you with anything. And if nothing else, you're going to hopefully walk away a little more educated than you were when we first, before we had that conversation. So 630-492-1912. 630-492-1912. Set that time up. Let's have a conversation, and we'll see where it leads us. So a couple updates. We are very happy. I know many of you know that we have been talking an awful lot about the energy strategy. So our energy strategy is something that is absolutely unique. If you sold a business, sold a building, if you are a high wage earner, especially given the time of year, taxes are top of mind for most people. Tax planning is something that it's really a year-round activity. It's not something you worry about the week before taxes are due or the last week of the year. It's something that we want to make sure that we're talking an awful lot about throughout the year. And as you know, I believe that tax planning, tax strategies, actionable strategies that can greatly reduce your taxable income is something that is overlooked when it comes to the individual investor. The $1 to $10 million investor generally is not getting appropriate strategies that can reduce your taxable income greatly. If you have listened to the show in the past, we always say our strategy in the KCP Energy Fund can reduce your taxable income by 70 to 80%. That's active or passive. So that's $70,000 to $80,000 per $100,000 invested. We did get the preliminary K1s for last year, and it looks like it came in at 90%. So $90,000 per $100,000 invested. You were able to reduce your active, your passive, your capital gains, your Roth conversions, your RMDs. So again, it's something that we are so passionate about, especially here in the Midwest. If you want to reduce your taxable income and have targeted distributions that are in the 15 to 20% range on an annual basis, then let's have a conversation. So we're really pleased that 90% is what it came in at last year. Everything we do is, we sell base case. A lot of times when you look at other strategies, whether it's investing in stocks, bonds, mutual funds, or any kind of investment, private investment, et cetera, they're selling best case. We truly are selling base case because we want happy partners. And so if we feel, just like we did with last year's, with the energy strategy, we said budget for 70 to 80% income offset. So $70,000 to $80,000 per $100,000 invested. If it's more, great. But we're highly confident that we can achieve the 70 to 80. And if you like the decision based on that, well, it came in at 90. Obviously, you're not going to have a complaint. And it's the same thing with the distributions. When you look at the market, most people don't have any exposure to investments outside of the stock and bond market. If you have energy exposure, if you own energy stocks, we need to have a conversation because you're not getting any tax benefits. When the markets go down, all stocks generally go down. So why not invest alongside the best operators in the world at the asset level? So again, 630-492-1912. Let's have that conversation. Markets are, if you look at where interest rates are, I mean, are we going to have a cut? Are we not going to have a cut? It's something that has been, it's not surprising to me that rates haven't been cut. I mean, but yet the market has run, which is fantastic. How long will it run? Well, I don't know. So, we have to make sure, again, that we are including strategies that can do well when the markets are negative. That is our core competency. That is what we're bringing to the table that others are not. And you have to ask yourself, I don't care who you're working with. I don't care how nice the marketing is. I don't care how much money you think the advisor makes, how nice his office is, how big the firm is. It's irrelevant. The question you need to ask yourself, the question you need to ask the advisor is, show me what percentage of my portfolio, whether it's 5%, 10%, 50%, whatever that number is, will have the ability to generate a positive return when the markets are negative. If you do not have that, then we have to talk. 630-492-1912. You do know that we do a bunch of bank notes. Bank notes are not unique. They're not new. They're not cutting edge. It's just most advisors don't do them because they have been typically for the ultra high net worth. And if you did not grow up as an advisor in the industry using these strategies, generally you're not going to adapt it mid-career or late career. We did. We were very early adopters in the banknote space. A banknote is very simple. It's a bond of the bank. It's a senior unsecured debt of the bank. It's just a bond that you have never seen before. And it takes some, education. I had a client the other day ask me, because we did do a new banknote, and I'll explain what that is here in a minute. It was priced this week. And they said, why doesn't everybody do this? And I said, that's a phenomenal question. I think it's a lack of education from the advisor, from the industry. That is, it's just the industry is broken. You know this. We talk about this all the time. I think 9 out of 10 advisors aren't worth the salt. Or it's just, I don't know. I don't want to maybe just, talk down on other advisors, but it's just advisors aren't bringing anything to the table that can do well when the markets are down. And so if you've listened to the show, that's one of the core differences that we have. And the banknote we just did was an income note. So there's two bank notes, generally a growth note and an income note. And we do, 1 or 2 a month. They are custom. So we're going to get better rates than just off the shelf type deals. And so the amount of dollars that we commit, we can get generally better rates than what anybody can find. So we're very happy with that. This was a Citibank bank note. So it's backed by Citi. So again, all of the banks these notes are backed by the counterparty is the bank. It's the credit of the bank. So you have to be with a very strong, it's just like any bond. I mean, if it's a bond, it's the bank that's backing it. So, we're very comfortable with Citibank's debt, Citigroup's debt. We're very, very comfortable with, what that is. This was a 3-year banknote, non-callable for 6 months. So chances are it'll never go 3 years statistically. Usually it's going to go 6 to 18 months, depending upon the market. But this paid 13% annual. Actually, 13.01% annual is what it was. And we get that coupon as long as the indexes that they were following, which in this case, we used 3 indexes. It was the S&P, the Russell 2000, and the KRE, the Regional Bank Index. So as long as those indexes from issue are not down 30%, then you're paid your 13% annual coupon. That's paid monthly. So whatever that amounts to, 1.15, I guess, or 1.1, you can do the math. So in essence, you had 30% downside to make 13% for the year. Listen, people with money are jumping on these notes. And here's the beautiful thing. They used to require, in many instances, 7 figures just to buy one note. Today, it's $1,000 $1,000, literally $1,000 will get you, one banknote. In this instance, it was a Citigroup note paying 13.01% annually, and it had a 30% protection on the downside for the coupon payment. So again, it may be for you, it may not be for you. We have to go over the risks. We have to go over, the rewards of the investment. But how many people in today's market would be very comfortable with allocating some money, knowing you can get 13% as long as the indices it's following are not down 30% or more? Or you can sit with the current bond strategy. You can work with, advisors who talk about balanced portfolios, which I have it's ridiculous. And look at what's going on in the bond market. Look at the returns of the bond market. How have your bonds, your individual bonds, your bond mutual funds, your bond ETFs, how have they done over the last 3 years, 4 years? I know the answer to that question. I hope you know the answer to that question. So, to sum up what we're going to talk about this week, I saw a very interesting marketing piece, the 6 questions to ask advisors. And we're going to go through them, and I'm going to tell you just what a joke I think that these are. And again, the industry is broken, and what it really comes down to, I was talking with a friend, and he said, well, he's not in the industry. And he said, what's your competitive advantage? And I said, in its simplest form, if you want to have the ability to make money when the markets are down, then you need to work with us. And 99 out of 100 advisors do not bring that strategy to the table. And, that is in its simplest form the goal of an advisor. That's how you compound money. That's how you compound wealth. And again, wealth is relative. Wealth to you may be 50,000. Wealth to another client may be 15 million. It's irrelevant how much money you have. When we do our dinners across Chicago, as many of you know, our tax planning, our tax reduction strategy dinners are very, very popular. They will immediately go on a waiting list. Usually we'll have 30 to 40 people per dinner on a waiting list because they're sought after. And we're bringing to market a strategy, again, like I talked about to kick off the top of the segment, a strategy that last year, had you invested $100,000, $1 million, do the math, you were able to reduce your taxable income by 90% and receive a distribution that's not tied to the stock and bond market. Doesn't mean that there's not risks, doesn't mean that there's not considerations, doesn't mean that it's a perfect investment for you. So we have to talk about those. We have to go over all of those. And I think one of the things, again, a differentiation of our firm is that we're going to talk about every single conceivable, possible, knowable, at least in my opinion, risk and reward of an investment. My job, as I've always said to everybody, is not to sell you. My job is to educate. If I want to give you every opportunity. When I have a call with somebody, especially for the energy fund, I want to give you every opportunity to say no, whether it's on the first call, second call, third call, fourth call, fifth call, whatever, meeting. And if you can get through your due diligence process, and if I can help you get through that due diligence process, and it's still appropriate for you, and it's still going to meet your goals, your objectives of reducing your taxable income, paying, mid to high double-digit distributions independent of the stock and bond market, well, then you know what? Then I did my job. And it's, I just think, again, it's the job of an advisor. I hear people, this last week I was with family and they said, one of the, a family member, extended family member met with their advisor, and they said at 65, they're going to have $12 million. And I want you to realize what these reports are based upon. These reports that the financial planning community uses are just they're just dated. And when we're looking at, trying to forecast future value of money, there's just, you either take a random sample of randomized returns and it gives you a probability of success, which there's so many, flaws in that, or they just take a straight linear number where you're going to do 7%, 10%, 13% a year, and the market's never going to go down. It's straight linear. And that's not realistic as well. So again, when it comes to financial planning, there are just so many issues in this industry. If we can stick with tax strategies, reducing your taxable income, allowing you to make money when the markets potentially are negative, have the financial plan in place, that's why we have a lot of happy clients. So give Paige a call, 630-492-1912, 630-492-1912. Let's set up our initial conversation, and we'll see if we can help you in any way. More after the break.
Perhaps the most impactful piece of preparing for retirement is determining your current and future tax liability and developing strategies to minimize the amount of taxes you pay in retirement. Tax planning can have a large impact on your wealth and the kind of legacy you will be able to leave. At Kuhn Capital Partners, we provide you with a retirement strategy that can help you minimize taxes in retirement and take advantage of the 2024 tax rules. Visit KuhnCP.com or call our office at 630-492-1912 to get started today.
Come back. You're listening to Destination Retirement. My name is Robert Kuhn, president, founder, Kuhn Capital Partners, registered investment advisory firm, fiduciary. Yes, we are a fiduciary. That is very important, especially in today's day and age. Even though it seems like everybody talks about being a fiduciary, but we actually are, and we are held to the fiduciary standard. So I think that is very, very important. The 6 questions to ask when finding a financial advisor. Again, everything we do is to educate you. Everything we do is to allow you to make a better investment decision. Our dinners are different. Our meetings are different. If you come to one of our dinners, especially our tax savings, tax strategy, tax reduction dinners, we generally hold them. We either do 2 dinners a month or 4 dinners a month at Morton's. We do them in Naperville, Northbrook, Schaumburg. So we usually follow kind of where Morton's is. For those dinners, if you have $1 million or more of investable assets, or it's actually $1 million net worth is requirement for the investment. It's not my requirement. It's just the SEC's requirement. So if you have $1 million or more, then you can invest in our KCP Energy Fund, and that's what we talk about at the dinners. So if you want to reduce your taxable income greatly and have mid to high double-digit annual distributions not dependent upon the stock and bond market, then it's going to be a very good dinner for you to attend. But it is different. We're not going over basic stuff. If you want basic stuff, go to every other dinner. If you want stuff you've heard 1,000 times, go to every other dinner. This is not that. We're going to give you very actionable ideas. So if you want to get on that dinner calendar to receive those invitations, they generally will have a wait list within a few days, generally 30 to 40 people. So if you have an interest, make sure you reserve a spot. And I understand why. I mean, last year, for example, we reduced taxable income, at least it looks like preliminarily by 90% per $100,000 invested. That's pretty big. So you put $1 million in, you were able to reduce your taxable income by $900,000. Put $100,000 in, you were able to reduce your active passive income by $90,000. Again, we're not tax advisors. Anytime we are talking taxes, it's for informational purposes only. These are very black and white tax strategies. However, especially in the energy space, they've been used for decades and decades and decades. But it's always best practice to make sure that that I'm not a tax advisor. I can't provide tax advice. Don't act upon my tax advice. Make sure you talk with your tax professional. If they have any questions, we certainly can have a conversation with them as well. So if you want to get on that list, 630-492-1912, 630-492-1912. So much of the information today is so cookie cutter. You know that. Nobody's talking about strategies that can do well when the markets don't do well. Very, very few advisors, especially here in the Chicagoland area. We're based out of Naperville. We're at 59 and 88, so very centrally located. We do have a national client base and national presence, so we do run the show in multiple markets. So if you are hearing the show, then we can work with you, which is really fantastic. So you don't have to be in Chicago. We have people that are in your area that we can work with you if you're looking for a second opinion. But so much of the industry is so cookie cutter. It's so basic, and basic sells. Basic is easy to acquire assets. Basic is easy for the advisor to monetize. Basic is easy for the advisor to grow their revenue, which increases their income, but it doesn't mean it's going to be good for you. You look at complexity. Complexity is not a bad thing. What do you think the banks do? What do you think the insurance companies do, especially when it comes to hedging and creating strategies that can do well when the markets are down? So I saw a very interesting article, and I like to see what people are reading, right? I mean, I'm a consumer, and I like to see what is out there. So I saw an article, and I saved it, and I wanted to talk about it. It's 6 questions to ask when finding a financial advisor, and we're going to talk about them. And we're going to talk about, well, the 6 questions that I would ask when trying to find a financial advisor, because obviously, the profession has grown. It's grown dramatically over the last decade. Investors have more choices than ever in how they invest their hard-earned savings, and it's important to consider, certainly, when you're going to work with an advisor who's going to get paid on your money, that you really understand what they are doing, that you really understand, is there a differentiation, that you really understand that it's just not more of the same, or a closet index fund that's packaged in a really nice offering with really nice graphics, with really nice folders, really nice presentation, but at the end of the day, you're just simply going up and down with the market, and that is the bulk of investors out there. 95%, I would say, that are just simply going to go up and down with the market. So the first question that they ask is, are you a fiduciary? That I agree with. I mean, that's a very simple question. That's certainly, if I had 6 questions to ask an advisor, I would not waste one on that question. I think there are more important questions, but it's important to know, are you a fiduciary? I think a client should clarify what type of standards their advisor is adhere to, as many are not legally bound to give objective advice. Especially, we see a lot of insurance advisors out there that are pitching these guaranteed products, these guaranteed income products, which we're going to talk about again here in a minute. And they say they're a fiduciary, but they're not legally bound by it. I personally think that you should always do what's right for the client, whether you're legally bound by it or not. I mean, that's just good business practice. It's just being a good human being. But unfortunately, a lot of people are worried about their commission, their revenue over the client's best interest. So, are you a fiduciary? Yes, we're a fiduciary. Do we act in a fiduciary capacity in all of our strategies? No. I mean, if we're going to use an offering from the insurance company, we're not acting as a fiduciary. But again, I think you have to just always do what's right for the client. So how are you compensated? That's a great question. I don't know of anybody that works for free. And if you do work for free, it's probably not somebody that you want to work with. We never hide from our fees. Some of our fees are more expensive than average. Some of my best investments have been the most expensive. Fees aren't the way you make an investment decision. Unfortunately, that's what Wall Street wants you to believe, because ETFs are almost free. And the reality is that free doesn't mean a whole lot in years like 01, 02, 0001 and 02 and 08 and 2018 and 2022. I mean, if you're losing 15, 20, 30, 40% net of that fee, I mean, who cares? I mean, it's irrelevant. But the very first question I get often is, we talk about fees. And again, fees are important. Fees are to be talked about, but that's not how you make an investment decision, in my opinion. Again, some of my personal investments have cost me the most. Our ultra aggressive strategy, which is 5 to 10% of somebody's portfolio, it's expensive. 2% net at 2% a year, and net of fees, that is done almost 650% versus the S&P 500 at 280%. Think about that. So yes, you're paying 2% a year, but net of that fee since 2015, you're up almost 700% when the market is only up 280, 285%. Which would you rather have, right? So we always want to talk about after fee returns, and it's important because you should have a good understanding of the costs associated with doing business with somebody. Because what happens when people come to us and they call Paige, and again, I don't think I gave you the phone number, but 630-492-1912. Nobody thinks they're paying anything. Nobody has a true grasp on the fees that they're ultimately paying, and there's fees in this industry that you see, and then there's fees in this industry that you don't see. So we want to talk about, one of our financial planning reports that we do run is a fee comparison report. I tell you, everybody says, I think I'm paying 1%. I think I'm paying 0.5%. Well, your true cost of ownership in many instances is 2 to 3%. You just don't see the total fee. If you own mutual funds and you have over $100,000, there's a good chance that you're paying, again, total cost, fees you see, fees you don't see, over 2%, over 2.5%. And we talk about the bank notes. So again, our bank note strategies are generally 1%. And like I told you earlier today, we did a Citigroup bank note this week that paid you 13%, as long as the indices it follows didn't drop more than 30%. Think about that. 30% protection to make 13. Well, our fee was 1. So your net return on that investment is 12.01 because it was 13.01. So, fees are important, but we can see fees that you don't see. And so if you own mutual funds and you have over $100,000 and you're paying an advisory fee on top of that, why? So again, it's, would I waste one of my 6 questions on that? No. Do we need to talk about that? I think absolutely. I mean, that's important to know what you're paying. And those clients that work with us, they know exactly to the penny before they sign on what they're paying. And then the insurance side, those strategies pay us a commission. And again, there's so much, especially on the radio, there's so much insurance business that is being done, annuity business that is being done. And those annuities are paying 5%, 7%, 9% a year. And you have to know what the advisor's being paid. Now, you may not pay that directly. It may come, quote unquote, from the insurance company, but you're still paying it. In my opinion, you're still paying it somehow, probably governed growth. But if you do have an annuity that provides lifetime income, again, I think of the people that own those strategies, 1 out of 10 truly needs it. Because if you own a lifetime income annuity, an annuity that's going to guarantee lifetime income, here's what you have to think. Here's how they're sold. Well, you're going to get guaranteed 6%, 7%, or a 30% bonus. Come on, really? Who's going to give you that of real money? It doesn't exist. I mean, you have to differentiate what it is and what it's not. It may be for your income number, but it's certainly not for real tangible money. And for those people that own those lifetime income annuities, you're paying in many instances 1%, 1.5%. And here's what you own. You own a strategy that allows you to sleep at night. No doubt about it. Absolutely allows you to sleep at night. But you're only taking your own money out of that annuity until the account goes to 0. Once the account goes to 0, then the insurance company is paying you out of their money. Actuarially, they know that's not happening. They would not be in business today if they knew that that was going to happen for everybody who owns those annuities. They govern the growth. They give you just enough growth for the account not to go to 0. And you're missing out on so much, especially in today's day and age. I mean, those annuities are only giving you 5% distributions, 6% distributions, generally speaking. Growth is, oh my goodness, it's been atrocious. And that's how they're governing the annuity. That's how they know that the insurance company will never go into their pocketbook to pay for that income. So again, do I like annuities? I like growth annuities. I like short-term growth annuities that are really just structured notes. There is a 5-year annuity that we absolutely love. It's just tied to the S&P 500, and it's going to give you the first 11.5% of the S&P on an annual basis, and that gain is locked in each year. Can't go down. So you don't have to worry about recouping losses. So do we like that strategy? Absolutely. It's really just a structured note that's offered by an insurance company. But yeah, that's a very compelling story for some safe money. Many people would like to know that, hey, I can't lose any money. Worst year is going to be 0. I get the first, currently it's the first 11.5% of the S&P 500 return, the price return on an annual basis. If I do get a gain, that gain is locked in, never to go down again. So if I get a gain in a year, that gain is locked in. So if the markets drop 10%, 15%, 20% the following year, you don't lose a penny. And then in the subsequent years, when the markets do rebound, you spend none of the growth trying to recoup those losses. Those gains go on top of the previous gains. So again, do I think there's a place for that in your portfolio? Absolutely. I will take that over a lifetime income annuity any day of the week. Now, again, If you have a couple $100,000 to your name and that's it, maybe the lifetime annuity should make some sense. But for the majority of the people who are buying them, you don't fully understand what you're getting. So give us a call, 630-492-1912, 630-492-1912. Set the call up with Paige, and we will have a conversation. So more after the break.
Puzzled by your retirement options? It can be hard to put together a retirement strategy without being able to see the whole picture. Kuhn Capital Partners takes pride in providing comprehensive retirement strategy services to our clients. Our comprehensive services integrate all aspects of our client's financial picture in a coordinated effort to provide for financial clarity and multi-generational wealth. Visit kuhncp.com or give us a call at 630-492-1912 to schedule a consultation today.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president, founder of Kuhn Capital Partners. Everything that we do is to educate you on strategies that can make money when the markets are down. Again, let's let the up markets take care of themselves. Do we love beating the market? Absolutely. Do we have aggressive strategies for some of your money that can beat the market, that has beat the market? Even though past performance is not indicative of future results, you have to understand that. But yes, our ultra aggressive strategy, again, it may only be 5%, it may only be 10% of your portfolio. It's almost doubled what the S&P 500 has done since 2015. Significant. So yes, we love strategies that can absolutely beat the market. But let's talk about strategies that can do well when the markets don't do well. That is what our main focus is. So if those strategies are of an interest to you, if you'd like to learn more about strategies that can help you reduce your taxable income significantly, last year it was 90% per $100,000 invested. At least that's what it looks like it's going to amount to. That's active income. That's passive income. If you sold a building, if you sold a business, if you are a high wage earner, let's talk about those strategies. Those are the strategies that we really want to bring to the table. That's the differentiation that we are talking about on a daily basis. Give us a call, 630-492-1912, 630-492-1912. We do run this radio show in multiple markets, so if you can hear my voice, then we can work with you. We are headquartered out of Chicago. We're in Naperville, just off of 59 and 88, so very centrally located. With today, I love seeing potential clients and clients in person. That's my preference. But if you're not ready to do that and you want to have a call or a Zoom meeting first to see if it would be worth your time, we certainly can do that as well. If you'd like to get on our tax reduction dinners that we host, again, there will be a wait list, generally 30 to 40 people deep. Give Paige a call, 630-492-1912, 630-492-1912. So questions that the average mainstream media is going to tell you to ask advisors. Are you a fiduciary? Good question. I wouldn't waste a question of my 5 or 6 if I had only to ask. But yes, good question. Are you fiduciary? How are you compensated? Again, very important. What are your qualifications? I think that's obviously very important as well. I mean, we need to know, who do you work with? What clientele is your specialty? We're unique in that area. And we have clients who have $100,000 with us. We have clients that have net worths of $50, $60, $70 million with us, and everywhere in between. My qualification or my expectation to work with us is, are you open to strategies that you may not readily be familiar with? Institutional grade, institutional quality strategies that the banks use, the pension funds use, the ultra high net worth use. If you are open to learning, if you're open to having a conversation about pros and cons about those strategies that can do well when the markets don't do well, then we're going to work with you. If you have 100,000, great. If you have 10 million, great. If you have 50 million, great. It doesn't matter to us. Now, the strategies may change. Our planning won't change. That is going to be, the same. Who we are is not going to change, but certainly the strategies will change. But it's important for you to know that. I mean, and it's, it's unique because, I hear often advertisements. If you have, $500,000, if you have $1 million or more, if you have $10 million or more, then, you can work with us. Well, you know what? My job is to educate, and I find a lot of satisfaction educating everybody, and that's my job. And so that's what we are going to continue to do as a firm. So 630-492-1912, 1912. What can I expect if I work with you? Okay, I mean, I guess that's, what are your service standards? What are your frequency of meetings? What are your interactions? How accessible you are? We're very accessible. If you're a client of mine, you know that. You have my personal cell phone. You can text me on the weekends. You can text me in the evening. It doesn't matter. To me, it's your money. Don't wait. You have a question, ask. Generally speaking, what we find are 2 in-depth reviews a year are sufficient. Some clients don't want any. I mean, when the market's going up, clients tend to not want those reviews because everything's going fine. I still like to do the reviews, but generally speaking, we're going to do 2 reviews a year, and we're going to have conversations via text or the phone multiple times a quarter, generally monthly, but we go overboard of just letting you know, good or bad, what's going on in the world, what our thoughts are. Do we need to adjust risk? Do we need to take more risk? Do we need to put more protection on? And that's just, that's how we can scale a business. That's how we can scale a business of hundreds of clients, of, making sure that our smallest client is still getting the same expertise, the same management, the same communication as our largest client. And unfortunately, in this industry, being independent is just phenomenal because it's really simple math. As an independent advisor, we use Charles Schwab as our custodian. We use Fidelity as our custodian. And so that means you just establish with our help, through us, you establish accounts at those institutions. We're not part of them. They don't say we're good or bad. We just met the criteria from a compliance standard point that we can use them. And then we just are simply the money managers on your account, and that's it. And so we want to make sure that you understand that when we are, managing your money, our strategies, that you have just a good understanding of what's going on in them, good or bad. I think it's just information. And so, generally that, 2 in-depth reviews a year. Usually we do a spring and fall, but we're ultimately going to, talk a lot. And we have the radio show. We do a lot of videos. We share with our clients just, monthly updates on the various strategies, just so they have a good understanding of what's going on. Because here's the deal. Markets don't just always go up. Now, it's been really easy lately, but markets don't go up all the time. And there's many people think that the markets could sell off in a significant fashion into the fall and into the winter, especially if interest rates are not cut. I don't know how they cut rates unless it's just truly manipulated, because if you look at GDP, if you look at what is going on in the world today, it's hard to make a case to cut interest rates because of what's going on with inflation. But again, it's above my pay grade, I guess. You just have to make sure we're staying in touch with our clients and what is going on. So those are the 6 questions. You didn't hear a single question about how do you not lose money when the markets are down. I mean, think about that. I mean, come on. Isn't that what investing is? I mean, how do what are you bringing to the table to allow me, like the dual directional banknotes? How often do we talk about dual directional banknotes? We're probably the only advisors on the radio, I know that for a fact, talking about dual directional banknotes. Again, what is that? It's really simplistic. It's a bank offering a senior unsecured debt, a bond with a QSIP, with a prospectus that is going to give you some growth on the upside, a cap on the downside. And it's very simplistic. But yet these strategies are not talked about. The last one we did was a JP Morgan one. So we're buying JP Morgan credit. It's a JP Morgan issued bond, 15 months in duration. It had 19% on the upside. So you knew they would look at the S&P hypothetically today and then in 15 months. And you had the first, this one was 18% of the upside. So again, it may be your safe money. It may be your equity money. It may act as a hedge. So you got 0 to 18%. So if the S&P was 5, you got 5. 10, you got 10. If it was 18, you got 18. If it was 20, you only got 18. All right. Most people are comfortable with 18% over 15 months. But here's the flip side to why it really, really should be in your portfolio. You had a 20% absolute return buffer. What does that mean? If the S&P was down 0 to negative 20, your return was whatever it was on a negative. It was the inverse. So it was positive. So if the S&P was down 5, it was positive 5, 10, positive 10, 20, positive 20. A lot of people think Too good to be true. Can't do it. Well, it can be. It's just simple hedging. These strategies are, in my opinion, very simplistic. They're just hard to implement. And even somebody with 10 million, 15 million, 20 million, you can't implement them like the banks can with a $2 trillion, $5 trillion, $7 trillion dollar sheet. So 18% on the up to 18% on the up, 0 to negative 20, you were able to have the positive return. And then if the markets were down more than 20, that's when you started to lose money. So if the markets are down, look at negative 20 as your 0. So if the markets are down 21, you were only down 1. 22, you were down 2. 23, you were down 3. Think about that. Where we're at in the market today, why would you not have 20%, 25% of your portfolio of your equity investments in this strategy to act as a hedge to an election, to interest rates, to geopolitical risks? That if you're content, which it was 18% a couple weeks ago, I don't know what it'll be today. It could be more, could be less. We've seen them in the 20s and we've seen them in, around 16, 17. But generally speaking, the upside is very, very good. And it's very comforting to know that the investment is predefined. We know the rules of the road going into it. And if you're comfortable with, let's just call it high double-digit maximum gains and then have the ability to make positive returns to negative 20 in the market, that is something that we have to talk about. So 630-492-1912, 630-492-1912. So yeah, it's unfortunate. It's unfortunate that those 6 questions that they want you to ask, very few people are going to tell you to ask an advisor, how do you make money when the markets are down? My challenge to you, if you're working with an advisor, if you're managing money on your own, I need you this week to ask your advisor or to ask yourself what bucket of money will have the opportunity to generate positive returns when the markets are negative. If you don't have that, we need to have that conversation. 630-492-1912. So those are the things that we want to talk about each and every week. And I think that's, the single greatest question you can ask an advisor is, how can I make money when the markets are down? And if you can keep with that philosophy, then, the up markets are ultimately going to take care of themselves. Because again, we talk a lot about, the industry talks about balanced strategies, right? And what is a balanced strategy? As we close this segment, it's just having some money in bonds. I mean, that's what a balanced strategy is, equity and bonds. That's not diversification. I mean, diversification is like our energy strategy, a strategy that can reduce your taxable income. Well, it did last year. It looks like 90% per $100,000 invested. That's $90,000. But those returns are going to act independent of the stock and bond market. And we're starting to see, when you look at the equity markets in the bond markets and just how highly correlated they are, there's a lot of hot money in the stock market. And institutions have always used private investments as a very, very large endowments and pension funds as a very large allocation of their portfolios. We're now starting to see individuals do that as well. And I think it's a must. And being independent, being a fiduciary, we have access to those strategies because, again, back to the balanced strategies, it is, okay, your bonds. Well, what have bonds done? Well, year to date, if you look at the Bloomberg Global Aggregate Bond Index, it's down 4.25%. So, I mean, you think about that. It started in 1990. That's 35 years ago. Only 2022 was worse. And that was the worst year in the bond market since the Civil War. So, again, we have to look at incorporating strategies that are different. If you want more of the same, if you want cookie cutter, if you want basic, then just don't waste your time talking with us because that's not something that we believe in. But if you want strategies, again, that will give you the characteristics, at least, to generate positive returns in up, down, or sideways markets, then we're going to be a good group to talk with. So 630-492-1912, 630-492-1912. More after the break.
When you think of a puzzle, what would you say is the most important piece? A corner? A side piece? I would argue the most important piece of a puzzle is the picture on the box, and the same can be said for your retirement. Robert Kuhn from Kuhn Capital Partners would love to show you your retirement picture. For more information, call 630-492-1912 or visit his website at kuhncp.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president, founder of Kuhn Capital Partners, independent registered investment advisory firm. Thank you for listening. If you can hear the radio show, we can work with you. We are headquartered out of Chicago. We are in Naperville, 59 and 88, very centrally located. So everybody in the Chicagoland area, we are certainly easy to get to. But if you can hear my voice, we are running the show in multiple markets, and we look to continue to expand that. Make sure you understand that we can work together. So easiest way to start that conversation is to call Paige, set a time up for an introductory call. It just gives us an opportunity to learn about you to learn about us, what you're looking for. Make sure that you're not wasting your time, that we're not wasting our time, and that ultimately we can deliver what your expectations are. And then if after that call it makes sense to meet in person, then we will do that. So that's obviously generally how we like to we look at our client acquisition strategy. We want to just learn about you, what your expectations are, what your goals are, what you like about what you're currently doing, what you don't like about what you're currently doing, what's keeping you up at night, if anything. And then if we think we can add value to your current situation, then we're going to share that with you. And we're going to make sure that hopefully you'll take it to the next step and we can get together in person or on a Zoom. So with that being said, give Paige a call, 630-492-1912, 630-492-1912. We talked about the income annuities earlier, and I talk a lot about them, especially on the radio, because so many people are selling them. You may not know that, but I can just listen to the show and know that no matter what it is, no matter what your goals are, no matter what your objective is, it's going to be an income annuity. They know that before you even call them. But you look at these income annuities, and again, I don't want to say that there's not a place for them. My opinion is typically that there's a place for them if you have under $100,000 or a couple $100,000 to your name. I think they're a phenomenal strategy because they are going to give you that peace of mind that you can get a paycheck for the rest of your life. But for people who have more assets than that, I think you are buying something that you don't fully understand what it is and what it's not. I want to stress to you that when you have a guaranteed lifetime income annuity, you are only taking your money out of that account until it goes to zero. Think about that. The insurance company is not on the hook for anything until that account goes to zero. Actuarially, they know the account's not going to zero. How is it not going to zero? Well, two things. They give you just enough growth, in that 2 to 6% range, to continue to see the account grow, and then they put a governor on your withdrawals, 4%, 5%, maybe 6%. And you have to understand that. I mean, that's how they make sure that account's not going to zero. What does that do to future inflation? Think about that. You have this asset, right? That it's not going to grow anywhere close to what the markets are going to do, right? And they're only going to let you take out 4.5%, 5.5% of that money. Well, what happens if inflation continues to rise, which we know ultimately is going to happen? I mean, that's just common sense, right? So you have this huge asset that you're not able to take advantage of, all because you can sleep at night because the account's not, you're going to have that guaranteed lifetime income. I mean, heck, we can get almost what these insurance companies are allowing you to take in a money market. So if you look at inflation, and I saw a phenomenal statistic this week, the Wall Street Journal did an analysis. They found that a commonly purchased basket of supermarket goods increased price by over 36.5% over the last 4 years. That's 8.1% per year, significantly higher than what the government CPI figure showed, which showed food inflation at only 24%. So think about that. Over the last 4 years, just to keep your standard of living, get the same amount of food, it went up 36.5%. So if you're tying yourself into these lifetime annuities that are governing how much money you can take out, is that going to be a good investment? So again, I like the safety component of it, but I think we can get that safety component with significantly higher distribution levels in other strategies. And the problem is they pay these advisors so much commission, 6%, 7%, 8%, 9% a year. You may not know that, but that's why these annuities are pushed so much. So again, our job is to totally uncover the good and the bad of any strategy. And I'm very concerned that these lifetime income annuities, you're locking in a distribution rate today that is going to be greatly affected by inflation. And you've basically locked up that money. And I just don't want to see that. So as we talked about earlier, do I like annuities? I like the growth annuities, right? I like the 5-year growth annuity that we talk an awful lot about. There's a lot of merit to that strategy. I personally think it's just a structured note. Well, it is really a structured note in an insurance wrapper. But yes, when you can let a client know that, here's a 5-year bucket of money, that you're 5 years out from retirement, or you just retired, you want to replace, the bond strategy, that your worst year is 0. There's a lot of that. To me, is a really great sleep at night factor. But here's the growth side of it. This is where it's significant. Currently, you get the first 11.5% of the S&P 500, the price movement on an annual basis. So 0 to 11.5% of the price movement of the S&P 500 you get. So if it's up 1, you get 1. 10, you get 10. 11.5, you get 11.5. 13, you only get 11.5. That's huge. 11.5% is huge on an annual basis. Here's the beauty of this, though. Once you get that gain is locked in. So if the markets drop 20% the following year, you don't lose a single penny. You're still didn't make any money, of course, but you didn't lose any money. And we have to continue this conversation forward, because in year 3, let's say the markets go back up. Well, you don't need to waste any of those gains trying to recoup your previous losses. The new gains will go on top of the previous gains. So an advisor can't come to me and say, well, you're anti-annuity. No, that couldn't be further from the truth. I'm anti-annuities that I don't think that there's much value for the client. I'm anti-annuities to these lifetime income annuities where people tell them that it's growing at 7% a year, which is factually inaccurate. Or you get a 30% bonus, which again is factually inaccurate. It's for income purposes. And I'm against annuities that are going to limit and put a significant governor, especially based on inflation, on how much of your own money that you can take. I mean, goodness. I mean, you've worked so hard for your money. Now you've got an insurance company telling you you can only take out 5% a year or 5.5% a year. So they know actuarially that account's never going to 0. So there's really no benefit of owning that. So you can't say that I'm anti-annuity, because I love the 5-year annuity. I love the 5-year growth annuity. I think it's a great bond replacement. I think it's a great equity hedge. I think it's a great bucket of money for your IRA, for some of it. So I'm not anti-annuity. I'm just anti-bad annuities. And unfortunately, the guaranteed lifetime income annuity, unless you have under $250,000, I just don't think there's a place for it. So we went over a lot today. Hopefully you find the show engaging. We're going to bring it. We're going to talk about the industry. We're going to talk about advisors and how we think most advisors are adding absolutely positively no value to the relationship. If you want to learn more about how to greatly reduce your taxable income, again, it looks like for 2023, it's going to be 90% per $100,000. Again, that's active, that's passive income. So if you sold a building, if you sold a business, if you're a high wage earner, you can do the math. Last year was 90%. Again, we say budget for 70 to 80. So I still want to stick to that budget for 70 to 80%. But last year came in at 90, which is huge. And the targeted distributions are mid to high double digits, independent of the stock and bond market. That's diversification. That is significant diversification. So if you want to learn more about that, again, give us a call. If you want to learn, we just, again, priced a city structured bank income note, paid 13.01%. That's what it was on an annual basis. So on the coupon side, as long as the indices that it followed didn't drop 30% or more, we received our monthly coupon with an annual rate of 13.01%. So again, significant downside to get a darn great rate of return. The dual directional banknotes are still phenomenal. Still seeing significant growth in those. We're seeing those price in the 17 to 18 to 19% range. Again, those are 15 months in duration. The beauty of it is the ability to make money when the markets are down. We use the 20% buffer. So from 0 to negative 20, you're able to generate positive returns. And then again, the 5-year annuity, the growth annuity, is very, very strong today at 11.5%. So with that being said, that and our financial planning and all that we do, hopefully you see value. in working with us. At least we do, and that's why we keep doing the radio show. So everybody have a great week. If you'd like to get on my calendar and have an initial introductory call, please give Paige a call at 630-492-1912, 630-492-1912.
Thank you for listening to Destination Retirement. Don't pay too much for taxes or retire without a sound retirement plan. For more information, please contact Robert Kuhn from Kuhn Capital Partners. Call 630-492-1912 or visit them online at kuhncp.com.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guests unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.